Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap here with Lance Roberts. Hey, Lance, how you doing? You look like you're piping in from someplace new this week.
Yeah, so it's Easter weekend, Good Friday today, so we decided to take a quick trip down to the beach. The wife, the dogs, the kids. So we'll see how this works out. There may be a lot of human trafficking going on in and out of the house. We'll see how this goes.
Hey, that just makes it more authentic. And who knows, maybe we have reason now to not go as long as we always tend to seem to go here. So I'll do my best to get you back to your family in a timely manner.
It is what it is, but we got a lot to cover this week.
We do. And it's interesting because it is a shorter week, right? We have the Friday is the market is not open today. So it's only 4 days worth of activity. Let's jump right in. Lance, what would you say the theme of this week was?
So this theme of the week was basically more volatility. We started the week on, kind of a down note. We had a boomer day on Wednesday. Markets were up almost 1.5% on Wednesday. Things were looking good, bounced off support. Then Thursday, I forget today's Friday. Thursday was options expiration. It was also pre-tax filing deadline, which means we had a lot of tax selling. People, selling assets to raise cash to pay taxes that time of the year. Markets gave up all their gains from Wednesday, closed right back down to where they started. So, it was one of those weeks where we had a lot of action, but actually wound up going nowhere at the end of the day.
All right. And I think that's pretty similar to what happened the week before, which is kind of interesting here. So this is a market, obviously, that seems to be sort of struggling to find a direction. Last week, you mentioned that the market had the opportunity to work off some of its overbought status, if I'm correct. And if it were, then that might open up the window for it to go higher from here. What are you thinking at this stage?
Same thing. So let's go back a little bit because, we do this every week. So we have to kind of go back several weeks now. We had the Russian invasion lows that we set back in March, and then the markets rallied a little bit, then sold off, came back down, retested those lows. And we talked about adding some positions into the portfolio. We bought a little bit of growth stocks here and there just because the market was so grossly oversold. At that time, we had real negative sentiment, negative positioning, and we said the markets were very likely going to have a bounce. And it was a good enough setup to take on some equity exposure for that bounce. And of course, we were 2 standard deviations below the moving average at that point. Had basically retraced, all the gains that we had made on a technical basis, and that set the market up. We had a really nice rally for about 2 weeks, and so this was now that the peak of that rally we talked about then. This was about 3 weeks ago. Now we talked about reducing that equity exposure that we added, and that the markets had gotten extremely overbought. We were 2 standard deviations now above the moving average. So over the last couple of weeks, we've been selling off. And so that overbought condition has now been reversed, and we're now back to oversold conditions. And we're very close to triggering a buy signal, which would give the markets a bit of a relief bounce here over the course of the next week or so. So I think that's still a very likely setup. And one thing we'll talk about today too is fixed income, because I'm getting lots of emails about bonds, obviously under a lot of pressure here on Wednesday and Thursday. Again, a lot of that.
I was about to go there. Yeah. So keep going.
A lot of pressure on bonds on Friday, particularly because that was options expiration day. And there's a lot of people that are positioned option wise on bonds. In fact, we've been doing the same thing. We've been selling puts on bonds at lower prices to, pick them up at lower cost, but getting paid a premium to wait for it. So, a lot of that options expiration action, of course, when people are having to sell assets to pay tax bills, they also look at the stuff that's performing the worst, right? That's the stuff we sell. So that just kind of all added to this very big sell-off we had on bonds on Friday. So, the initial emails I'm getting is like, oh my gosh, rates just keep going up, bonds keep going lower. And it's like, yeah, right now the Fed is getting ready to hike rates. Bonds, bond yields rise when the Fed's getting ready to hike rates. And you've got to make a decision here whether or not, if you're trading bonds, that's one thing. If your goal is to trade bonds here over the next 3 to 4 weeks, that's one thing. Our positioning is 6 to 9 months out to the future. So we're using these opportunities. Bonds are bonds very rarely get 3 standard deviations below their 52-week moving average. That's a rarity. We're 4 standard deviations below that moving average now. That's something that very, 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 very rarely happens. But again, it doesn't mean that it's an immediate buy signal, right? It's one of these things that you're looking at to buy at lower levels. We want to buy things cheap, and we want to buy things that are grossly underpriced at the moment, both on a sentiment basis, a positioning basis. And we talked about last week a bit about bear markets, is that at the bottom of a bear market, nobody wants to buy equities. And what you're looking for at the bottom of a bear market is you're looking for that super negative sentiment, basically the positioning of people that I just want nothing to do with the stock market. They just sell everything, they go to cash. That's what you've got going on in the bond market right now. This is one of those times where that old adage, blood in the streets, is there. And you try to talk somebody into buying bonds right now, they're like, oh, no way, they're just going lower. Interest rates are going to the moon. They're not, because we're about to break something in the markets here pretty quick. 5% mortgage rates are already impacting the housing market pretty dramatically. Auto sales in the recent CPI report, we're starting to see a correction in prices there. High prices cure high prices, and eventually that's all going to filter its way through here. Weaker economic growth later this year is deflationary, and we very likely saw the peak in inflation in this last report. At the bottom of bear markets, people don't want to buy stocks because they don't want anything to do with the stock market. And it's the old adage, blood in the streets. And that's a very difficult thing to do. And that's where we are in bonds right now. Nobody wants to buy bonds because they're convinced that interest rates are about to go to the moon. But there's a lot of things that are telling us that we've probably seen the peak in inflation, and the year-over-year rate of change in inflation is now going to become more complicated, because each month that we now go forward, the 1-year trailing month behind us. So when we get into May, comparing to April of last year, when we get into June, we look at the May over May comparison. That year ago period is now going to be rising in terms of inflation. So when we start calculating the year-over-year rate of change in inflation, that number is going to have a much more difficult time going higher. So we're very likely going to see inflation start to drop pretty quickly. And here, let me just put it this way, Adam. If, for mathematicians out there, it doesn't take a lot of work, but if you just assume that the inflation index doesn't change for the next year, in other words, every month we're printing 289 or whatever the index was for April. If 289 or whatever it was for the month of March, going forward, if that index level doesn't change, the rate of inflation, because of this year-over-year comparison, will go to 2% in 12 months. So we'll be back to the Fed's target rate of inflation. Now, that doesn't mean anything got cheaper, right? We talked about this before. Gas is still the same price, oil is still the same price, everything else, food is still costing you through the nose. But the rate of inflation will fall. And when the rate of inflation falls, so do bond yields. There is a very long 100-year correlation between inflation rates, interest rates, and economic growth. And those don't deviate from each other very much. Interest rates on 10-year treasuries cannot sustain levels higher than the rate of economic growth, because they're linked by how things operate in the economy. So if the economy is going to slow back to 2%, interest rates can't be 4%. They will be 2%.
Okay. Great answer. Number of topics in there, and several that I think people are of different minds about right now. Right. So I'm sure a number of people who are watching who are saying, I disagree with Lance. I think inflation's going higher still from here. It hasn't peaked yet.
And that, look, that could be, and they could be right. There's still some thoughts about higher rental rates, right? So homeowners equivalent rent, that could still go higher here for a couple more months. We could see higher oil prices. Higher oil prices could go back up to 130. That's going to pull on through a bit. So I'm not saying that, there's 100% probability that inflation has peaked, but we're likely pretty close to it, particularly when the Fed starts to hike rates. They do that to slow economic growth and quell inflation. So if we didn't hit the peak, it's coming in the next couple of months. And again, because of that year-over-year comparison level. Yeah.
And I agree. And just for transparency, I was on Twitter the other day making the argument that I also agree. I think it likely peaked in March, for all the reasons that you just mentioned. But anyway, some disagreement on that. There's other disagreement where, some people are saying, "Oh my God, bonds." They've heard the explanation on this program from you week after week, but they're just not on the bond train, right?
It's fine. It's fine. It's no problem.
Which is fine. Yeah, no, exactly. And you've done a really good job of explaining why you own them, and we're not going to go into depth on that here because folks can watch previous videos. I guess my question for you on this, just representing that cohort for a second, is there are people that I have talked to very recently. In fact, I just talked to John Malden this morning and Michael Pinto yesterday, and both of them think that the Fed is going to be more committed to sacrificing markets to tame inflation than many people think. So my question for you, Lance, is just what would get you to consider, I know you've said that you don't think the Fed's going to be able to go above much more than a 1% federal funds rate before that thing breaks and it's forced to pivot, right? But what would challenge that assumption in your mind? If you saw it, you would say, I need to reevaluate.
Yeah. So first of all, there's a couple of things we need to unpack there. I'm not, I have a thesis that I'm working on, right, in regards to our portfolio management. And so for us, bonds are a twofold factor. They are a hedge against equity risk, and they are a capital gain trade if I'm right about my thesis on inflation. So let's assume that, and again, this is the important thing to remember, like I'm not 100% bonds. Lacey Hunt runs a bond portfolio. So his portfolio is 100% bonds. That he runs a bond fund. That's what he does. Bonds for us are a hedge. So let's do some basic math here. Let's assume our portfolio is 10%, long duration bonds. The rest is equities and cash. Okay. If bonds decline 10%, which they've done over the last few weeks, the portfolio is down 1% because of those bonds. It's not the end of the world. Yes. And the mistake that people make is they look at specific things in their portfolios like, oh my gosh, that position's down 10%. Okay. But our equities are up 4%. So what's our conversation here of what we're looking at? And so it's important about when we're talking about asset allocation, risk management, these type of things, you've got to keep these things all in perspective. We talked about auto mechanics, I think, last week. And
that great engine analogy. Absolutely.
Exactly. So this is the thing to keep in mind, is that we have a thesis. We're willing to push this thesis a while longer until we're proven wrong. One thing that I'm very confident on is that I'll have a better opportunity to rebase my position in the next, not too distant future. Nothing goes straight down, nothing goes straight up. So even if let's just assume I'm completely wrong on my bond position, I am still going to get a point here because bonds are very extended to the downside. Again, 3 and 4 standard deviations below their long-term moving averages, extremely oversold, very negative sentiment. And just like stocks, if I told you that stocks were 4 standard deviations below their moving average, they were extremely negative sentiment, negative positioning, what would you tell me? Would you tell me that was a buying opportunity for stocks, or would you tell me that stocks are just going to go to zero?
Right, absolutely.
Yeah.
I mean, this is we talk a lot about this on this channel. There are sort of short-term realities that happen throughout longer-term cycles, right? So,
right.
Totally get it. And look, you are doing what a financial advisor does to earn their pay, right? Which is you are, trying to identify assets that you think are mispriced, right? And by definition, you want to get into them before they reprice. To the rest of the world, sometimes that might look like you're bucking the trend, right? And people looking from the sidelines can throw peanuts at you and whatever during all that.
Well, look, it's a great point. 2 things you said right there were great points. First of all, you said, as a financial advisor, this is what I'm doing. And as the normal financial advisor in this country is stick all your money in a basket of ETFs and hold on to it and write them up and down and hope things turn out okay in the end. We're actually managing money, and that's a very different story from the average advisor in this country. So I just want to make that clarification, because what we do is not what the normal advisor does. right? We do the financial planning. We do all of that for our clients. We do all the estate planning, the back work. We make sure their financial goals are intact, but we don't just put them into a basket of ETFs or mutual funds and say, hey, hope it all works out for you in 20 years, right? We actually manage risk. We actually do the things that we talk about here on this show every week is exactly what we're doing in our portfolios. The second thing, though, is that when you're talking about, these changes to portfolios and making these positional bets, right? But as a financial advisor, that's one thing to consider is that, this isn't what you're going to hear from normal financial advisory work. But the other side of this is also that we are making bets on outcomes, and if and when, and back to your original question, by the way, if and when the facts change, I will change our positioning. And I'm not wed to this position. But again, as you said a second ago, there are short-term outlooks, which right now bonds look terrible technically. I mean, they look horrible. If I was doing day trading on bonds, I'd be, short TBT. But, that is, these things are so oversold here, they're going to bounce. It's just a function of one piece of economic news, weaker inflation rates. And those, by the way, are coming. You take a look at the freight index and others, those are already starting to show you signs that the economy is slowing down pretty rapidly.
Oh, absolutely.
So I think I'm very close to being right on this. And y'all can keep throwing peanuts at me for now, and it's completely okay. I deserve it.
Yeah. And that's exactly the role of the professional financial advisor, right? It's to come up with a plan that's based upon the theses, right, you talked about, and to execute the plan until the data shows otherwise. And there are times there, especially for diversification, which we talked a lot about, I think in the last video we did, or the one before that, where some of the times you almost have to kind of hold your nose because you don't necessarily like the trade, emotionally, but, you're doing it for the purposes of a well-diversified portfolio. But I want to get back to my original question on this, because I know a big part of your thesis, kind of from the macro sense, is, again, something's going to break, right? We're going to get up, I'm going to use your words from previous videos again, to around 1% on the Fed funds rate. Something big's going to break, and the Fed's going to be forced to capitulate. So in terms of something that would sort of shake that thesis, would it be getting a 1%, maybe even above, and Powell coming on and telling the world, I'm doubling down on rate hikes? Or, I'm just, what would cause you to say, maybe Powell, maybe this is going higher than I thought?
Yeah, no, look, it would be exactly that. Like I said, I don't know exactly if it's 1% or if it's 1.25% or if it's 1.5%. What I do know, and to your point, and we're already starting, look, the Fed's hiked 0.25%. And the 10-year treasury rate is already running up ahead of him. The two-year treasury, which if you go back and look at the 2-year treasury rate and overlay that on top of the Fed funds rate, you'll see that there is a very, very high correlation between those two rates, and the 2-year treasury leads the Fed. And what the 2-year treasury is saying right now is that the Fed's going to hike to 2.5%. And that's where a lot of the commentary comes from in the marketplace. The 2-year treasury is already predicting that the Fed's going to hike to 2.5%. And maybe that's the case. But just last week, that rate started to come down a bit. And we'll kind of see how this plays out. But so I don't know exactly, is it 1%, is it 1/4, 1.5? But already with just a 1/4 point hike, we're already starting to see an impact to the housing market. We're already seeing an impact to the mortgage refinancing market. We're already seeing, slowdowns in economic activity in a variety of areas. We're seeing credit card payments go up for consumers that are already having a hard time spending. Take a look at what happened with retail sales this past week. Retail sales, and again, the trick about retail sales, importantly, when you look at that, is that we measure retail sales in dollars spent, not in volume purchased. And that is a very big factor of this. Again, I always use the tank of gasoline as an example, because you buy the same amount of gas, most people do, buy the same amount of gasoline kind of every week, right? You drive to work, you drive home, you drive to work, you drive home. You fill up the same amount every week. You're spending more for the same amount of gasoline. And that shows up as higher retail sales. It doesn't mean you're buying more stuff. It just means you're paying more for it. So, but even that rate of retail sales, we saw an impact of higher prices, higher inflation. Online sales fell sharply, but we saw, auto sales were still high because people were buying cars or whatever it was. And those prices are still high, but even auto prices and used car prices are starting to show weakness. So again, we're already starting to see those cracks, but the auto market falls apart. That's really not a big issue for the Fed, right? Okay, car prices fall. They're not going to freak out over that. Where the Fed gets in trouble is when it does something that impacts the bank. Did you pay attention to what JP Morgan said this week? JP Morgan reported earnings, and what did they do? They increased their loan loss reserves by $900 billion. I mean, sorry, $900 million. I wish it was billion. Yeah. JP Morgan increased their loan loss reserves by $900 million in the quarter. They're already expecting a pickup in potential credit card defaults, late payments, those type of things. They're already prepping their book. Doesn't mean it's going to happen, but even they realize, JP Morgan even recognized it. Sorry, Jamie Dimon during the conference call even acknowledged that they're expecting a slower economy later this year. So if that is truly the event, I think I'm right on my thesis.
Yeah, and actually, I want to really dig into that, because I think that these storm clouds of reduced economic growth, right? And I think that's probably a polite way of saying it, because I could easily be saying, hurtling towards recession. I think that is what's occupying at least more and more of my focus right now. And certainly the people that I'm talking to are bringing up a lot of these same issues that you're mentioning here, Lance. So I actually referred to them in the recent interview I did with Michael Pinto as the parade of horribles that we're seeing here now, where we're seeing mortgage rates go up, right, which is killing the HELOC and the refi markets, right? We're seeing, and of course that depresses that should start bringing housing prices down, which will create a negative wealth effect around people. We're seeing, as you and I have talked about with GDP, Q1 GDP, a tiny fraction of what Q4 GDP was last year. We're seeing, some of these bellwether prices for inflation, like the auto market, right, which was kind of the poster child for crazy inflation in 2021, is now beginning to cool off, right? So there's, and I'm just getting started here, but there's all these factors that are showing that we are highly likely to see reduced economic activity this year as more and more of these chickens come home to roost. I mean, just inflation itself, the cure for high prices is high prices, right? They get so high that you have demand destruction. That is what the Fed is trying to create here by saying, look, we're gonna raise interest rates as much as we are, right? So I guess where I'm going with this is up until now, I think everybody is understandably completely freaked out by the inflation monster. But I'm wondering if the disinflation and maybe even eventually deflation monsters are the ones that we should be more worried about, at least up until the point where there is this Fed pivot, potentially that might happen. And if the Fed goes back to easing, then all bets are off. But up until then, I almost feel like the disinflation and deflation monsters are the ones we should be really keeping our eyes on. What do you think?
No, I think you're absolutely right. Now, look, and maybe I didn't really answer your question, well enough before about, the Fed, and they're committed to hiking rates for inflation. You and I talked about last week is that Jerome Powell may talk tough, but we know from experience that he kind of buckles like a cheap suit as soon as something bad happens. I mean, he caved to political pressure in 2018. The market was down 20%. Donald Trump threatening to fire him as Fed chair, and he rolled over and stopped hiking rates and completely reversed his whole decision at that point about monetary tightening and being nowhere near the neutral rate. He should have kept going. He should have let the market continue to collapse. He should have let valuations get back to normal. Didn't do it though, and I highly suspect that he has not toughened up since 2018. And when something happens in the market, again, it's got to be something, it's not autos. It's going to be something that affects the banks. Why? Because the banks are the members of the Federal Reserve. So when the banks become challenged, when the banks are threatened, the Fed will stop their inflation push and go back to bailing out the banks. And that's going to be some credit related event. What kind of credit related event are we talking about? I have no idea. We didn't know about Lehman before it happened. Bear Stearns was kind of a shot across the bow. So, as the Fed is doing this, the thing that will eventually trigger them into reducing rates is some type of credit, not I want to say a credit crisis, right? I don't want to go back to the financial crisis scenario where, the whole world's coming apart. Could that happen? Absolutely. There's certainly risk in there. We have not solved the bank's problems. Banks are not nearly as well capitalized as everybody thinks they are. We never reestablished mark-to-market accounting for banks. So there's a lot of even today, there's still a lot of bad assets on their books. But it can be a variety of things that challenge the markets, challenge the credit markets. It can be everything from leveraged loans to collateralized loan obligations to high yield debt to zombie companies in the small mid-cap space. We've talked about all these risks before, but that'll be when those cracks start to show, that's when the Fed will immediately begin to backtrace on their inflation fight and start going back to focusing on financial instability.
All right. Well, look, I got two other kind of related questions to this, and then I want to ask you about an event that you guys have coming up that I just learned about. I guess first on trouble in the credit markets. Again, I'm coming on the heels of this interview I just did with Michael Pinto, and he said that one of the indicators he looks closely at is the spreads between junk bonds and treasuries. And when they begin to blow out, that's going to be an important signal to him. Are there any other indicators like that you guys watch closely to try to get a sense for, okay, when there's some issue in the credit markets that the Fed might care about, this might be a early, canary in the coal mine indicator for you?
Yeah, no, the spreads are big, and we watch everything from double B to compared to A-rated spreads. So we have a lot of different spreads that we keep a watch on. There should never be a point in history where you're getting paid 3% to own high yield junk. The reason it's high yield is because it's on the verge of default. And when you're seeing triple C rated bonds yielding 3 and 4%, there's a problem with the credit markets. And when those yields start to go up, again, this is where the zombie companies get trouble because they can't refinance at higher rates. So those spreads are really important. The other thing that we watch, of course, is the yield curve. Now, there's been a lot of talk about the yield curve over the last couple of months, right? It's like, oh my God, the yield curve's inverted, a recession is coming. And the one thing we've been talking about here, every week is it doesn't matter until the yield curve uninverts. And right. So this week, the yield curve uninverted, I get all these emails says, the yield curve uninverted. So the recession's here. No, hold on a second. We track 10 major yield curves, and my bad for not explaining this previously. It's not one yield curve that matters. It's when you get multiple yield curves that all invert at the same time. So we track the 10 major yield curves, and what you need is 50% of those yield curves to invert. We only got to 20%. So we're not in that territory yet that suggests that we're going to have a recession next month, 2 months from now, 3 months from now. We need to see more of those yield curves invert. And that will happen as the Fed starts to hike rates. We will see those yield curves start to invert as the economy slows down. So I would suspect that we'll see the recent uninversion will eventually reinvert in the next few months. It'll get fairly deep. We'll get more than 50% of the yield curves that we track inverted. And then that's where you and I will start talking about, hey, we're pretty close to having a recession. But again, we're not there just yet. But again, all these other things that we're talking about, credit spreads, economic data, all this is all going to be leading indicators to, a potential recession later this year or early in 2023.
Okay, great. And then it's kind of a related question to that. I had an animated discussion in the video we released today with the guys from New Harbor. But if you expect yields to go higher in general, and I'm not just talking about treasuries or what I'm saying across the board, if you expect macro conditions to get worse, which we both expect, where credit trouble should start, right, should be in this high yield space, right, in the junk space, so the most vulnerable companies for the reasons you mentioned. They're sort of a step away from insolvency or whatnot. So is now a good time to be considering shorting junk bonds?
It depends on your time frame. Look, as we talked about, a couple of weeks ago, we've been slowly kind of building into our long dated treasuries. And, we bought bond, earlier this year, we talked about how we bought long dated treasuries, then we sold them on the rally. And then we bought some more on the next dip, and they've gone a little bit lower since then. And now I'm getting emails, I'm getting hate mail from people. It's like, you were wrong, yields keep going low. It depends on your time frame. If your idea is that you're going to short junk bonds right now, today, and if it doesn't work for you in a day or two, you're going to sell it. I probably wouldn't short them here because we're due for a rally in the market. High yield junk is very correlated to equity risk. So if we do get a rally in the market short term, junk bonds are going to perform better because junk bonds are when we talk about them having a correlation, right? They track the same as the equity index. And so
as equity index.
Right. So a lot of people buy junk bonds so they get the yield that's higher than the S&P 500 and they get the gains with the index, right? So it's kind of a way, it's kind of a bond way to play the equity index.
Yeah, it's a great point. Sorry to interrupt, but let me amend my question then, which is with this thesis that the situation is going to worsen and the Fed's going to hike up until the point that something breaks. Does shorting junk bonds until something breaks, because you're basically riding the worsening conditions up until the Fed has to step in, right? Does that make sense here or not? I just look at it and think, oh, it's kind of interesting.
No. You're right. And I was going to answer your question, and she didn't need to amend it because
I was too impatient. Sorry.
No, it's okay. But I needed to clarify the difference between views, right? And again, I'm getting chastised by people who bought. I got an email from a guy recently. He's like, I bought TLT a couple of weeks ago and I'm down in it. I was like, okay, so what? Buy some more. But what's your thesis? If your thesis is I bought it and I lost money and oh my gosh, I can't stand to lose money, then don't buy. I mean, honestly, don't invest. If you can't afford to lose money, you shouldn't be investing. But
sorry, but this is important to underscore. If you're buying a security and you're expecting it has to go up tomorrow, then you're not an investor, you're a day trader.
Exactly. And that's my point. And that's my point. And if your whole thesis is I can't afford to lose any money, you've got other problems you need to sort out first and then start thinking about investing later. But again, I wouldn't short high yield junk here because we're due for a rally and they're correlated to equity. So I think that, if you bought it today, you're going to lose money in the next couple of weeks. However, to your point is that, yes, I would short junk bonds on a rally but again, now you got to have the time frame. I've got to be willing to buy junk and keep buying it until it peaks. And that peak will come when the economy peaks and you begin to get some type of impact to the overall markets. But we don't know when that's going to happen for certain. We don't know how it's going to happen. We don't know what the trigger is. And this is the point about investing, which is we're building a position with the expectation that we're going to break the market. And I want to be in ahead of that, because when the market breaks, you will not have a chance to either go long treasury debt or go short junk, because it's going to move so fast you'll never have an entry point.
Yeah, that is a great point. Okay, great. Well, look, last time we were on the program, and I'm going to try to wrap things up here a little early for us, and 45 plus minutes is still early, I guess.
I just got rid of all the kids, so now I've got time. So
I know. And folks, if you're seeing some jump cuts in this video, it's because we've had a lot of little breaks we needed to edit out as poor Lance is fielding all these people walking in front of his camera. Yeah. But last week we talked about, sort of positioning for a recession, and not even necessarily portfolio wise, but just if we have growing confidence that a recession is coming, what are things that just regular people, should be doing today to prepare for that? And you, two things. One, you mentioned that you've got some great talent at the RIA, on your RIA bench, who are, big financial planners and have lots of good advice to give people on that, sort of, not just, hey, we're going to build a portfolio, but all the certified financial planner tactics that they educate people with. And so I asked the audience, hey, would you like us to do a video where Lance brings that crew on and we dive deep into kind of, both retirement planning and prepping for recession, and the feedback was very strong. So Lance, we're going to have to do that at some point soon.
Good.
I also just learned from you guys that you are doing a live event in Austin, Texas, I believe. And so this would only be for people that can actually go physically come to this event. But I wanted you to be able to let folks know whatever details about that event you would want them to know for the folks that are listening who are in Texas.
Yeah. So, and we'll do this. And look, two things. I'm not a financial planner, and I'm a portfolio manager. That's what I do. And this is the one thing that I truly love about the shop I'm with now is everybody has a defined role. Nobody messes with my portfolio management. I don't get involved with personal financial planning. But I've worked with a lot of financial planners in my, through my career over the last 30 years. And the guys that we have, Connie Mack, Danny Ratliff, Richard Rosso, they are by far the very best financial planners I've ever worked with. They're very patient, they're very knowledgeable, but they do things that a lot of financial planners don't do, like adjust for variable rates of return, actually account for bear markets, these type of things. And they adjust inflation rates for, different things. So these are all really important things, to making sure that your portfolio aligns with what your financial goals are, because otherwise, it's kind of like building a house. Is that if you just try to build a house without a blueprint, you'll have something, but it probably won't last for very long, and it probably won't look like the way you thought it was going to look. And that's really what the financial plan is that blueprint. And the way we work in our shop is you do the financial plan, then I design the portfolio to fit the plan. It's not just investing money in the markets, because that's how you wind up taking on too much risk. Then your emotions don't allow the portfolio to work because it's too aggressive or not aggressive enough or whatever it is. So there has to be some logic behind the asset allocation that you choose and how it works with your long-term financial goals. And so they're really great at this. And two things. So one, yes, we have a seminar coming up in Austin. It's on April the 30th in Austin, Texas. And I think you've got the link you're going to put up on the Wealthion site. If people want to register, you get all the details. But it's combating inflation and retirement. And this is one of our most comprehensive classes that we cover. It covers everything from Social Security to Medicare planning, maximizing income and retirement, taxation, Roth conversions, all these things that are very important to maximizing efficiency and accuracy in your financial planning. They do a great job. They're very patient. They're great teachers. But that's on April the 30th in Austin. So if you want to go and you live in the Austin area, we'd love to have you. And then, but we also do these online every now and then too. And I'll get them on here, right here on the Wealthion channel, and have them do their combating inflation retirement for all your viewers. Because it's very educational. I think they'll get a lot out of it.
All right, that sounds great. So two quick things. One, the URL that I was sent was sort of one of those super long tracky URLs. So I'm just going to set up a redirect. So folks, if you go to wealthion.com/Austin, AUSTIN, that link will go over to Lance's site and it'll have all the details for this thing. Yep. So if you're in the Austin area, want to go to the actual physical event there on the 30th, go check that out. I appreciate that offer that you just made there, Lance. And maybe let's just sort of survey folks in real time here in the comment section. You guys have the ability to put on some of these events that you have in the past done regionally, but you could do it virtually for the entire Wealthion audience if folks are interested in. Folks, if you want Lance and I to kind of put our heads together and try to think of a couple of different topics that could be very good for the entire Wealthion audience and to do a dedicated, online event around, if that's of interest to you, let us know in the comments. And if it is, I'll bother Lance and we'll come up with a plan for that.
Absolutely.
All right. Well, as we begin to kind of land the plane here, Lance, I do want to let you get back to your family and enjoy your long weekend. I look at your trade alerts that you let folks sign up for free. That shows exactly how you guys, when you make a change in your portfolio, it shares the trade. It doesn't look like you guys made any trades this week unless I missed them. So nope. What have you done this week?
Nothing. And actually, this is the second week in a row we've made no trades. We're still carrying about 30% in cash. Our portfolio is balanced leans more towards the defensive sector side of the markets right now. We still have our growth exposure, but that's been reduced. And we're kind of now and so we kind of positioned for a sell-off. And again, as we talked about a couple of weeks ago, I think it was about 3 weeks ago now, the markets have gotten very overbought. We reduced equity exposure. So there really hasn't been anything we've needed to do over the course of the last couple of weeks. Our gold position's working fine. So that's all the hedges are doing what they're supposed to do, with the exception of bonds. I know bonds are down, but still got a thesis we're working on with that. But I wouldn't be surprised if we don't maybe add some equity coming up this week. I think there's a couple of interesting companies we're looking at. We are going into earnings season right now. So, this is where we really start trying to pick through some of the earnings reports, and particularly if a company announces good earnings, they get hit because of guidance or whatever. That's where we start looking to maybe buy something for the portfolio. So we may actually wind up doing some trading next week.
Okay, good. Well, I'll look forward to talking with you next week in terms of what those were. Really interesting that we didn't stumble into some outrage for the week, because there's usually something that winds us up here. Probably good. So
I've got one for you.
Oh God! All right, what?
Elon Musk and Twitter.
Well, I was going to raise that. It's so funny. I was going to raise that in parting. Look. I'm going to try to spare you from getting stuck here for another half hour, just getting your rage on with me. But I got to say, I've watched that with a lot of enthusiasm, just in terms of the angst that his surprise bid there kicked up. I do find it highly hypocritical, of the people that are rushing to say, hey, look, the last thing we want is, Elon Musk, a billionaire, to own a media company. That's a very bad thing when you look at every other major media company. Mm-hmm. Some of the biggest criticism against Elon Musk, that he shouldn't be allowed to do this, is coming from the Washington Post, which is owned by the world's richest man right now.
Right. Second richest man. I thought Elon Musk surpassed him.
Oh God, you know what? He might have. I haven't looked at the rankings recently, but right. Okay. Sorry, but only the world's second richest man. Yeah.
Actually, had Jeff Bezos not got divorced, he would be the richest man. So okay, that's the other side of this.
Second richest man with an asterisk.
Exactly. But two things. One, I thought the bid number was great. That really tickled me. $54.20 for Amazon. Of course, you drop the 5, it's $4.20. That's his favorite number, right? So, he's made more than one comments or, over time, and alluded to the 420.
Oh yeah, no, he's Mr. 420. Absolutely.
Yeah, exactly. So I thought that was very good. But yeah, it's interesting to watch the blue check marks just literally melt down and lose their mind over Elon Musk potentially providing a platform for actual free speech. How dare he actually allow for free speech? And if this doesn't wake you up to what's going on in this country, I really don't know what's going to, because when you have a guy that's saying, look, all I want to do is release Twitter for what it is and just make it the town square. You got something to say, you go say it. Now, look, free speech does have limits. There is, free speech as a constitutional right does have limits. You cannot walk into a crowded theater and yell fire. That is not an ability, and that is a limit of free speech. You can't say anything you want, but it has gone way too far on Twitter and other social media platforms about what information is being censored, what is said, what can't be said, deplatforming people just because you don't agree with their opinions. Look, I'm no fan of Alex Jones. I'm no fan of Donald Trump as a commentator. I've got issues with everybody loves Joe Rogan. I got issues with some things that Joe Rogan says, but that doesn't mean that just because I don't agree with Joe Rogan sometimes that he should be, deplatformed and he should be banned from his space. That's not what this country was founded on. That's not what our constitutional right says. And what's interesting to me more than anything else is that the very people that are saying that we shouldn't have the right to free speech are the very people that are involved in the press and journalistic organizations that depend on the ability of the First Amendment to be able to print a lot of the nonsense and false information that they print under that guise of, hey, you can't limit me, even though you may not agree with me, because I have the First Amendment right to say this. but yet they don't think that right applies to the average everyday American.
Yep, agreed. And the whole thing is crazy making on so many different dimensions. And I know everybody has, different opinions on it, so we may get a dust up in the comment section here on this. But there's two quick things I want to point about. One, again, just to show some of the twisted logic, the pretzel logic that's being used against a lot of the people, kind of against, this bid. There's a guy here named Max Boot who I actually don't really know him all that well, but apparently he's involved in media, apparently a neoconservative guy. But he says, he's concerned about what could happen if Musk buys Twitter. For democracy to survive, we need more content moderation, not less. Right, which just goes against that's kind of like, the 1984, newspeak, right? Up is down, left is right, that is good. But I also find it, getting back to Wall Street, which is sort of where our bread and butter is, Lance, I find it so, again, incredibly hypocritical that Goldman Sachs came out and said that 54.20, that's too low of a buyout price. Where right now Goldman has a sell rating on the stock with like a target price in the 30s, yep. Right? So, in one hand, they're selling this research to clients saying Twitter's overvalued at its current price. We think you should sell it because it's worth only 30 something. But now they're coming out because they don't like what's happening here and trying to use, no, that 54 totally undervalues this company, right?
So I think it's and you're absolutely right. And look, here's the interesting byline to all this. Which is, this really shows you two things. First, capitalism works. Here's a guy that took an idea of electric vehicles and became the world's richest man over ideas like putting private rockets into space, building electric vehicle, building batteries. He took on companies like GM and Ford that have been around 100 years. He took them on and he's beating them in that space. So that tells you right there that capitalism works. And, when you start taking actions, and by the way, free speech is part of capitalism, by the way. So once you start taking actions, we like
to think free speech, free markets, right? Yeah,
exactly. Yeah. And you've got to have that. And to make capitalism work, you've got to have the ability to go against the grain. That's where the great opportunities are made. Can you imagine what would have happened to Elon Musk if we all said, no, you can't talk about electric cars, right? That's just, that's why it's so important. The rule of law, we've talked about the importance of that. But the second thing about this is that here's a guy who says, look, I've got capital. Here's a company. I want to go buy it. And he's already the largest stakeholder in Twitter as it is today at 9.2%. And he said, look, I'll go buy the company. I'll take it private. I'll get it out of the public hands. I'll make it a private company again. And we'll allow free speech to run, and I'll run the business this way. Okay, fine. Right? Nothing wrong with that. He takes over Twitter and he changes the Twitter functionalities, and people go, you know what? I don't like it. We're all going to go over to Instagram. Right. And then Twitter fails and goes out of business. That's capitalism, right? If he makes the purchase and then he changes it to something that consumers don't want to pay for, it goes out of business. And as we've talked about before, that's the key to capitalism, is allowing businesses to fail. So, here's and one last point about this. What if it was Berkshire? What if it had been Warren Buffett that made the $54.20 bid for Twitter? People would be all over the media going, this is the greatest offer ever. If Warren Buffett buys it, that's what it's worth. He's the intrinsic value guy. This is going to be great. He's going to take it over and he's going to make it a bazillion-dollar company, right? The media is so two-faced about this whole thing. And what they're missing is that this is just the function of capitalism at work. And look, here's the other part of this. It's Elon Musk, right? He's known for pranks before, but what a genius play. He buys 9.2% of the company, releases a 13F, the stock runs up 16% the next day. So already he's minting money on his original investment. Then he comes out and says, hey, I'll pay $54.20 for it. The stock runs up again. I would not be surprised if in his next 13F filing, there's no Twitter shares.
Yeah, you see that he dumped it all. Yeah, maybe. And who knows? would he then be under the scrutiny for manipulating the stock, whatever? Yeah,
the SEC's already all over him anyway.
I know. And look, I want to actually get to an even more meta point here. Before I do, though, I just want to acknowledge, because I'm sure there's already been 1,000 comments on this in the comment section below. I totally get the criticism. I think much of it very valid. That hey, Elon Musk's success, a lot of it is due to government subsidies. So we
absolutely,
the guy to hold up as the paragon of capitalism, because people can make the argument that, hey, this guy's pull in tons of public funds to finance his success. But that being said, I also agree he's been one of the most transformative entrepreneurs of our generation, right? But I think the bigger meta point I want to make here, building off what you said there, Lance, is the importance, and I would say the criticality of allowing the free market to work, right? To let good ideas surface, to let companies try different things, and let the ones that are successful thrive, and the ones that choose the wrong decisions to go to the dustbin of history. And I think that's been the key theme of really the past 20 years of central planner intervention that's been going on here. And I think we can make analogies in the media space as well. But we have not been letting the players with the flawed models go out of business. In fact, we've been propping them up. That's all of what the 2008 crisis did, right? We should have let all those big banks die. There would have been plenty mid-sized banks to step in to replace them and to run things much more sensibly going forward. But instead, we doubled down. We rewarded the bad actors. They got even too much bigger to fail. We're seeing the same thing in lots of other different industries. I don't know if you and I have really ranted about this yet, but I find it pretty hard to name an industry now, a commercial industry, that hasn't evolved into a cartel, where it's a few big players, and they have basically, written the regulations and rules to make it incredibly hard for new entrants to come into the space. And I think what we're seeing here in the Twitter world is they don't want a disruptor to come in here. They love their little cartel. They don't want a guy to come in and mess up the good thing they have going on. So anyways, I'll try to get off my soapbox here.
It's funny because you said that, is that on the radio show on Wednesday, when JP Morgan announced earnings, I said, well, the financial mafia is starting to announce their earnings this week. JP Morgan, Wells Fargo, who's the mob boss of the mafia, is Wells Fargo, of course. And this is exactly to your point, is that we have all these cartels that are essentially, when it comes to the major banks, they're essentially criminal enterprises on a lot of fronts. I mean, look, JP Morgan's been caught how many times manipulating metals markets? And where most people would go to jail, they pay a fine and say, "Oh, sorry, you caught me."
Oh yeah, and that's like the least of their infractions, like that.
Right. No, it's worse. But here's the thing, and this is the thing to remember. This is why I call them criminal mafia, criminal cartels. Is that if I go to the bank and I rob a bank of $100 million, and I get caught, right? So I go to court, and you have been caught and say, Mr. Roberts, you were caught robbing the bank of $100 million. What we're going to do is, instead of jail, you pay us $5 million as a fine and go on down your road, and you won't have to admit or deny any wrongdoing. Just pay us $5 million and go on your way. Well, if I can rob somebody for $100 million and pay $5 million and keep $95 million, I'm going to do that all day long, right? I mean, why would I? That's a tax, right? That's income tax. So I just pay an income tax on all that. And look, they get caught with this constantly. They're constantly getting caught. Wells Fargo, how many customers did Wells Fargo rip off, and they got fined a paltry fraction of what they stole from customers? I mean, it's sad that our financial and capitalistic society has gotten here, but this is why so many young people are so upset about capitalism. This is why 30 or 40% of young millennials are voting for socialism now, because they look at this stuff going on and it's not fair to me. So why the hell do I want it?
Right. It totally understandable. Totally don't think it's the solution, but to your point, it is totally understandable why the people who are getting screwed by this system are looking for some alternative, any alternative.
Look, and to your point about Elon Musk, and we can wrap this up, is that, look, I'm not a huge fan of Elon Musk. My point is, look, every great fortune in history started with a crime, from the Rockefellers on board. The Rockefellers were smuggling, rum. So, there's, everybody that's made a lot of money, there's always negative detractors on how they got there and these type of things. But look, if I can create a business and I can use government subsidies, I'll create a business using government subsidies, whether it's defense contracting or whatever it is. Is it, does that mean that I made it on my own? You can argue the point, but if I was smart enough to use and to get government subsidies to build a business, why wouldn't I do it? That's the game that we play. And this is the same thing I talk about with taxes all the time. Everybody's upset about taxes. We need a better tax system. Look, the top 10% of people pay 90% of the taxes. Yes, a lot of rich people don't pay much in taxes because they have ways to avoid taxes. They're not doing anything wrong. They're simply playing by the game. If you don't like the game, change the game, right? Don't blame the players.
Right. You're making the don't hate the player, hate the game.
Yeah. So if you don't like the tax code, come up with something better. Go to a flat tax rate. Go to a minimum rate on some level. I mean, whatever it is that you want to change it to, change it. But just don't sit around and complain about it and then do nothing about it, and keep voting, by the way, for the same people that keep doing the same stuff over and over again.
Right.
Now, see, now you got me on a rant.
I know. It's such a Pandora's box as we open like 50 other thousand things we could talk about. And actually, I have kind of a harebrained tax proposal for you that I'm not going to mention now because we both got to go. But if you remember in one of these future videos and want to get me spun up on it, just remind me of it.
Gotcha.
All right, folks. With that, we will bring things to an end here. I hope everyone's having a great long weekend. Lance, go enjoy your time with your family. Please thank them for letting us steal you for this hour. And folks, if you are continuing to enjoy these weekly market recaps with Lance, do me a favor and support this channel by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Lance, look forward so much to whatever happens in the next week, sitting here and quarterbacking it with you next week.
You got it. See you then. Thank you.